Hello viewers. In the previous session we discussed what is the fair value gap, how it forms and how many types it has. In this particular session I will show you how to utilize fair value gap to its maximum potential, how to enter in the market and how to exit from the market using fair value gaps. So without wasting any time, let's get started. I would say the best we could make out of the fair value gaps is to trade it in the trending markets. By the trending markets, I mean the markets are either trending to the upside or it is trading to the downside. So, what we would do, we would place the Fibonacci retracement. First of all, let me write the trending market. So, you would keep it in mind either to the upside or either to the downside. Now, let's suppose the market is trading to the upside. How we could trade the fair value gaps and how we could enter in the market or how we could exit from the market. Let's suppose it is an impulse move, it is a retracement move, again impulse move. Now, higher highs are created by the market, higher lows are created by the market, which indicates that the market is trading to the upside. Now, what we would do, we would measure the whole wave. What is a wave? This one move is a wave. This is another wave, and this is another single wave. We would place Fibonacci retracement at the low, extend it to the high. What we would place? We would place Fibonacci retracement. In the ICT and SMC, Fibonacci retracement is only used to measure the move, to measure fair value gaps, and to measure order blocks. Let's suppose it is the whole move and it is the 50% area of the move. Now, what we would do, we would divide the move into two parts. The area above the 50% is premium area, and the area below the 50% is discount area. So we would only take entries in the discount areas when it is the case of uptrend, and when the market is trading to the downside, we would only take entries in the premium area. So if here is a fair value gap or an FVG and the market retraces back to it, let me remove the stuff. Let's say here is a fair value gap, it is a discount area, keep it in mind. The market retraces back to this area and it fills the fair value gap either with its body or with its wick. But always keep one thing in mind, that the candlestick must not close below the gap. It must close in it or it either wicks through the fair value gap. That is the area where we would take a buy entry in the uptrend. Now we could target the gap, the first gap, which is at the high of this move. This would be our first TP, you could say. And secondly, we could take the high of this, which is higher high, the high of the higher high, this area. This would be our take profit. Similarly, we would trade the market in the downtrend, but that would be totally upside down. The market is trading to the downside, and we would only take entries. Let me draw it. The market is creating lower highs, lower lows, lower highs, and lower lows. Now, again, it is the 50% area. This is the premium area. It is the discount. Let's say the market retraces back to the premium area, and now here we will look for fair value gaps. We will make sure that the market retraces back to this area and it does not close above the gap, above the fair value gap, then it will be totally invalid for us to use. So let's say it gets close in the gap. Now we will take a sell entry at this point, and we will target the first fair value gap at the lower low area, or we will target the area below the lower low. Now, as I described it on the board, now let me take you to the charts so you could better comprehend it.
So traders, as I stated, the best use we could make of fair value gap is to trade it in the trending conditions. And it is the current gold chart which we could clearly see is in a clear uptrend. So if you remember, I had said that we will only measure one single move of an uptrend or of a downtrend. Let's suppose, let's say this is the trend, this is the point, the low. We will consider this example. We will place our Fibonacci retracement at this low and we will extend it to this high, which is a single wave. Now we will extend it to the right, and you could see I have only marked quarter levels and 50% level on the Fibonacci retracement just for the purpose to measure only moves, wicks, fair value gaps and order blocks. Now the area below the 50% area is discount area, and the area above the 50% area is premium area. So what we will do, we will only trade the discount area in the uptrend, and we will only trade and we will only consider the fair value gaps in the premium area at downtrends. So now as we know, this is the 50% area of the wave. Now let's remove the Fibonacci retracement so we could clearly see the chart. Let's suppose we take this fair value gap. Let me zoom it. And you can see this red bearish candle has filled the gap completely, which is a green signal for us to enter in the market. And the best strategy, the best thing which we could do is to place our stop loss below the low. We would have placed our stop loss at this point, which is also the low of the fair value gap, which is the low of the candle which has formed or which has helped the candles to form the fair value gap. So we would have placed our stop loss at this point, and as there is, we can see this was the first fair value gap. It could have been our first target, and our second target could have been above the high. So that's how we will trade fair value gaps in the trending conditions, it was the example of the uptrend. Now let me take you to the downtrend scenario. Dear viewers, the previous example which I gave was in the gold market, which was of an uptrend. This example is of a downtrend market, and which I had to find it after a bit of hassle. It is in the DXY, which is clearly in a downtrend from some time. The market is making lower low, lower highs, lower lows. This one is not a lower high, but still, if we look at this low, it is clearly lower than the previous lows, which fulfills the criteria of a downtrend. So now let's say the market is making lower highs and lower lows. Now what we will do, let's suppose put the Fibonacci retracement at this high, extend it to this low, and now we will extend it to the right, so we could see again the levels are clear. The area below the 50% area is discount. The area below the 50%, above the 50% area is premium area. And as I have said, and you would have yourself watched it several times by, or you would have heard it from the ICT himself, that we will trade the fair value gap in the downtrend only at the premium area. Now mark the 50% area with this horizontal ray and remove the Fibonacci retracement. This fair value gap is at the premium area. The market retraced back to this fair value gap, and the candles closed in it, which is a sign the market will respect this gap. So now we would have placed our stop loss above this high, and we would have placed our profit target at the lower fair value gap of the wave, and the second profit target would have been placed at the lower low or the area below the lower low. So that is how we would trade fair value gap in trending markets. See you in another session. Take care.